In this video, we'll be discussing how I screen for value companies. This is the way that I do it. I use a software called YCharts. I feel that it's one of the best softwares out there when it comes to screening and looking for companies. So let's just get right into it. I'll show you my entire process. You guys can go on ycharts.com. They do offer a week-long free trial, and you can determine if you feel that this software is right for you. But this is what I use, and I'm not sponsored by them or anything. I just feel like it's a really good software. So let's start right off. The first thing that I do when screening for companies is I limit my universe of stocks to those that are in Canada and the US because I just feel that I have a better grasp of the markets here. So the first step I do is I click on securities and modify, and I limit it to the Toronto Stock Exchange as well as the major US exchanges. And so if you look at it, we started off with about 29,000 securities, and then by limiting our universe, just to Canada and the US, we basically take it down to, about 12,000. There's a button here, I think it's behind where I am on the screen, it's called remove duplicates. I basically do that, and that'll remove companies that are listed on multiple exchanges, as well as companies that have like an A class or two classes of shares, like Berkshire, for example. It would only leave so like for example, in Berkshire's case, you have the A class and B class shares. The B class, like the Berk B, that one there would remain because it's higher volume, but the Berk A would not show up. So you're basically removing the duplicates. I don't know if I click it again here, you can kind of see. So Ayers Acquisition Corp, you see that there's two here. If I click remove duplicates, now there'd be only one. So that helps also just make things a little bit simpler for me to see and to visualize. Then I start going to my metric filters. The thing with metric filters is we can't be too specific when applying metric filters, because we don't want something to what we don't want to do is apply too stringent filters at the beginning and then eliminate things that just miss those filters. So what I do is I put pretty broad filters. I don't try and narrow it down too much. I just try and narrow it down so that it's a little bit more reasonable for me to look through. The first thing that I put up usually will be PE5. What the PE5 is the 5-year average earnings over the last 5 years divided by the current price. So it's a little bit less volatile than PE, because with PE generally you're looking at like the trailing 12 months or the previous year or even the next year's predicted earnings. The problem with that is if you have one bad year, now you're eliminating companies that could have excellent future prospects for you. But the PE5 at least gives you the average of the last 5 years of earnings. So even if they have 1 or 2 bad years over the last 5, it'll still be included, which is okay. Obviously, I want positive earnings over the last 5 years on average, so I set the minimum to 1. And then on the top end, like I said, I'm not going to be too stringent, because if the company was growing significantly over the previous 5 years, then their PE5 was probably going to be a little bit high, even though their current earnings power would be a little bit higher than the PE5 would indicate. So I put up to generally like a PE5 of up to 50. So up to 50 times the trailing 5 years average earnings. I feel like that would be, even in the case of a growth company, that pretty much the highest I'd be willing to do. So I put it between 1 and 50, and you can see the current universe is about 12,000 securities, but if we apply that, it takes it down to 2,200. So that already, just like these two things that I did, basically limit my securities to Canada and the US, and then also not pay more than 50 times the average 5 years historical earnings, but also want companies that have some profitability demonstrated. That right away now takes it down to only 2,200 basically. So that's pretty much the first screen that I do. I feel like, already since we're down to about 2,000, I wouldn't really do too many more metric filters. I'll go back to like the security aspect of things and then eliminate companies based off of their sector that I don't understand. So there's a lot of sectors that I just avoid because, I feel like as a retail investor, they are outside of, just in general as an investor, they're outside of my circle of competence. The first thing would be basic materials, okay? Energy is another one. Healthcare is another one. So those three pretty much I just eliminate right off the bat. So and you can see that then eliminates pretty much another 400 or so securities, brings it down to about 1,800. Now, sort of when we're at this level, we start to really narrow down the securities that we're able to, or that we're going to be analyzing. There's a couple more filters we can always apply. Like if we're looking for quality, we can always look at the return on capital employed. And again, I don't use a single year metric. Like I wouldn't use this one because this is only looking at the previous year's earnings. Like what if they had a bad year for whatever reason? Like there's so many things that they could do that would turn down the return on capital for a single year. But what's more reflective would be something like a 5-year median, right? So if we look at if companies that have deliver returns on capital on average over the last 5 years, or rather their median over the last 5 years of above 10%, you'll see that this number of 1,800 securities gets turned down way down to basically 1/3. So just that single metric now, just these two metric filters, the PE5, meaning they're trading between 1 and 50 times their average 5 years earnings, and the return on capital being above 10% on average over the last 5 years. Now we've basically turned it down all the way to only like less than 700 companies, and I wouldn't feel super comfortable applying more filters than this personally. Another thing that you can also apply on Y charts that's good is equations. Like you can do it so that way your return on capital 3-year median is higher than your return on capital 7-year median. That's another one sometimes I'll apply, and the reason for that is because I want to see that the return on capital is increasing over time rather than being eroded. Because if it's eroding and the return on capital is going down, then that generally means that the company is losing any sort of advantage that it has and is going to probably, die out sooner rather than later. Like decreasing return on capital is probably one of the worst signs you can have, so we would want to eliminate that. And now all of a sudden you get it down to like only 400 companies. Important to note, there's no, I haven't done any sort of balance sheet checks or anything like that, which probably would be a good idea because we don't want to get companies that have like huge amounts of debt or anything like that. Y-Charts has like a proprietary balance sheet health check, which you can apply if you look at like, if you search fundamental score, and you set that at like a minimum of 5 or something, what that will mean is it's going to probably eliminate companies with really unhealthy balance sheets. Obviously, if you set it to 10, it's going to only choose companies with stellar balance sheets, but we also have to be willing a little bit to sacrifice that, if we're looking for great value. So anyways, I set it to 5 or greater. That pretty much eliminates companies that have ridiculously bad balance sheets, or at least it alleges that it does. You still obviously have to look. And now we've sort of narrowed down our universe of companies to look at. You can also add in things like the market cap, and then start screening pretty much from the cheapest, like from the smallest companies up. So if you filter from market cap, you can start from these companies and just click on them one by one. And if you find something that interests you, you go ahead and you investigate it further. So, for example, if I start here, Educational Development Corp, when I click on it, it'll open up a new page and I can read what it does. And if I think that it's something that seems interesting, I can also look at something like, I don't know, the free cash flow, and just get a sense of the profitability of the company. Already I can tell you that this probably is not going to be something that interests me. The market cap is obviously very low as well, and we can look at the enterprise value just to get a sense of the balance sheet, and it has quite a bit of long-term debt. So this is probably not a company that I'd be interested in. Yeah, definitely not a company that I'd be interested in. So we move on to the next one, and we just do basic screens as we go down, for each thing. To be honest, after just doing that, probably this fundamental score is not too representative of balance sheet health, because that Educational Development Corp had basically like 20 times its probable earnings power in terms of long-term debt. So you learn as you go along. But so just keep that in mind. I think that this is a great resource. This is how I would screen for companies. And now that I got 300 or 400, I would just literally click on each one. Like look at Educational Development Corp. That only took me about 20 seconds to do, like not even, right? So 20-second very quick filter. That means you can probably do about 3 companies a minute, meaning if you're doing, let's say 3 companies a minute, 60 minutes in an hour times 3, you can be looking at about 180 companies per hour. So to go through all these companies is probably going to take you like 2-3 hours. Not that bad. Like, I mean, you can do it 1 hour a day and be done in 3 days, basically. basically, looking through your universe of companies. And you can do that basically every week. And you can also, another thing that I look at, which is not really on here, would be the daily lows and the 52-week lows. That's another place that I look for as well. And then obviously my own industry knowledge. Like I probably have hundreds of companies memorized in terms of their earnings and their revenues. Not specifically memorize everything, but just a general gist of what the company does and how much it makes. And then if I do see companies have fallen that I recognize, I will always look into them again. So this is my strategy. I hope you found the video informative. If you have any questions, please feel free to leave them down in the comment section down below, and be sure to like the video. Thanks.